Welcome to the Daily Block, the top events happening in the past day in crypto and why they matter. Crypto market bloodbath, about $230 billion wiped out. Bitcoin below $105,000. More than $1.2 billion liquidated. Markets puked across the board as risk aversion spiked. Bitcoin slid under $105,000. Ether and most alts were down in the mid-single digits to double digits. And fear gauges fell into fear territory around the low 20s. Derivatives got absolutely crushed. On-chain trackers and exchange data show roughly $1.2 billion to $1.8 billion worth of liquidations in 24 hours, with leveraged longs taking the worst of it. Traders flagged tight funding, credit jitters, and macro headlines like trade and tariff fears and bank stress as the ignition. Why it matters for traders: extreme deleveraging resets funding and leverage dynamics. It either flushes weak hands and sets up a relief rally, or it cascades into further capitulation. Key areas to watch: the $100,000 to $105,000 band for BTC and nearby ETH support zones. Risk counterpoint: violent washouts can create short squeezes that rip price higher fast, so faded momentum is dangerous if you're trying to trade the bounce. On to the next. France expands AML probe into Binance as MyCAAC readiness checked. French regulator ACPR has widened anti-money laundering inspections, focusing on major crypto platforms, and put Binance squarely under the microscope while assessing its readiness for EU MiCA licensing. This isn't a random audit. It follows years of warnings and compliance demands. It could force Binance into tighter KYC, withdrawal limits, or even operational constraints in EU markets if deficiencies are found. Why it matters for traders: any regulatory hit or restricted operations at Binance tends to drain liquidity from BNB and big caps, and raises counterparty and routing risk for Europe-based traders. Risk counterpoint: regulators can also push business to compliant venues, and on-chain liquidity may reroute through decentralized options, so market impact is significant, not necessarily permanent. Sliding into the third. Tether freezes 22 addresses, totaling 13,410,000 USDT across Ethereum and Tron. Tether pulled the remote and froze 22 addresses, holding about 13,410,000 USDT across Ethereum and Tron, reminding everyone that the dominant stablecoin has centralized controls and can be immobilized when flagged for illicit activity or regulatory orders. The frozen addresses don't look like exchange whales, and price reaction was muted, but the move rekindles debates about how permissioned your dollar exposure really is on-chain. Why it matters for traders: freezes highlight a real counterparty and control risk even in supposedly neutral stablecoins, so sudden on-chain liquidity drains can blow up collateral and margin positions. Risk counterpoint: market participants are increasingly diversified across USDC, BUSD mirrors, and on-chain dollar baskets, so single issuer actions have diminishing but still painful bite. Next up, Binance cleared to re-enter South Korea via GoPax acquisition approval. South Korea's financial authorities signed off on Binance's GoPax takeover, giving Binance a route back into the Korean market for the first time since 2021 through majority control. That reopens direct access to a huge APAC user base and the potential for regional flows, listings, and localized product distribution to come back through Binance's rails. Why it matters for traders: renewed Korean access lifts regional liquidity and listing power for Binance, which can affect token demand and order book depth on projects with strong APAC communities. Risk counterpoint: local regulators will still be watching closely, and Binance's re-entry might come with strings attached that limit its playbook. Keep it moving. Ripple reportedly leading a $1 billion fundraising to build an XRP-focused treasury. Bloomberg says Ripple is engineering roughly $1 billion in institutional money to create a digital asset treasury that would pile into XRP, with Ripple itself contributing XRP and also acquiring G Treasury in a $1 billion deal to expand treasury services. If real, that's a massive centralized accumulation plan. Think concentrated buying power and a corporate balance sheet explicitly aimed at absorbing supply. Why it matters for traders: $1 billion accumulator of XRP could meaningfully tighten available supply and act as a bullish flow into XRP price if executed. Risk counterpoint: large corporate accumulations are politically and legally visible. They can invite regulatory scrutiny and, if leaked, trigger front-running or speculative squeezes that reverse quickly. Sliding over. Cardano whales dumped roughly $350 million worth of ADA. Price slammed hard. On-chain flows show big ADA transfers and coordinated whale selling equating to about $350 million, which triggered a nasty one-day hit as ADA fell around 9% and far more over the week. That kind of concentrated sell pressure pulled liquidity out of the order books, hit stops and amplified volatility as traders scrambled for exits. Why it matters for traders. When large holders exit a top 10 coin, it can create intraday liquidity vacuums and teach where stop clusters and reaccumulation zones will form for tactical re-entries. Risk or counterpoint. Whale movements aren't always purely bearish. Sometimes transfers are custody or exchange rebalancing, and price can recover quickly if bids step in under perceived fair value. Onwards. Shiba Inu collapses about 7%. Tech's flash risk of a deeper slide. Shiba Inu lost roughly 7% on the day, putting monthly losses north of 25%. And technical setups plus multi-million USDT outflows from exchanges suggest momentum is tilted toward further downside. Analysts are pointing at a potential move toward roughly 30% lower if the 0.0000105 support level gives way, while meme coin sentiment remains fragile thanks to huge supply and limited on-chain utility. Why it matters for traders. Meme coins turbocharge volatility and liquidation risk. When blue-chip meme tokens like SHIB crack multi-month support, margin and cross-asset contagion can accelerate drawdowns across speculative altcoins. Risk counterpoint. Meme coin dumps often produce emotional oversells and quick rebounds when speculative buyers return, but timing those rebounds is a high-variance gamble. Final headline. SharpLink raises $76.5 million in equity at a premium and signals more ETH buys. SharpLink Gaming sold 4.5 million shares at $17 apiece, raising $76.5 million at about a 12% premium, and signaled it will likely use proceeds to accumulate more ETH for its treasury. It already holds roughly 840,000 ETH. An equity raise at a premium for a crypto-native firm suggests institutional appetite, and that corporate treasuries are still a narrative vehicle for buying spot ETH. Why it matters for traders. More institutional treasuries buying ETH increases persistent spot demand and supports narratives around ETF flows and staking yield, which can structurally tighten supply. Risk counterpoint. Treasury buys can be announced to influence sentiment and may not always translate to immediate market buys. Execution timing matters, and other treasuries may pause and risk off markets. If you liked that, subscribe for the daily hit of market chaos and the context you actually need. That's Today in Crypto, where the gains are imaginary and the pain is real.